Thanks for joining us today on The Close. I'm Marella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following out of the BNN Bloomberg newsroom. The Prime Minister, along with leaders from Europe and Japan, have condemned in the strongest terms Iran's attack on civilian infrastructure and the closure of the Strait of Hormuz. The blockage has left hundreds of tankers stranded there. The leaders say they are ready to support efforts to ensure safe passage through the strait, calling freedom of navigation a fundamental principle of international law. The U.S. President Donald Trump is calling for de-escalation after Iranian and Israeli strikes hit major energy sites across the Middle East. An attack on Qatar's massive gas hub caused significant damage, while Israel struck Iran's key South Pars field. Trump says the U.S. was not involved in the Israeli strike and warned Iran against further attacks on regional energy infrastructure. And we are watching shares of Micron Technology today. The company revealed plans to boost capital spending, which drew concerns among investors. Still, Micron reported adjusted earnings well above estimates, with a revenue of $23.9 billion US dollars, also topping forecasts. Micron produces memory for NVIDIA and is benefiting from surging demand of NVIDIA's AI chips. Uber plans to invest as much as $1.25 billion US dollars in carmaker Rivian to help launch a robo-taxi fleet. It will be available eventually in Canada, the U.S., and Europe. Uber and its fleet partners will buy 10,000 autonomous Rivian R2 robo-taxis and make them available exclusively on the Uber app, starting in San Francisco and then Miami in 2028. Another dismal day for the North American market. The TSX today down almost another 500 points or 1.5%, taking the composite down to under 32,000. Let's get to south of the border. Not a lot of movement for the S&P 500, but another down day for the Dow, down about 0.4%. The NASDAQ about 0.33% down today. So the TSX under pressure, as you saw, hitting a 3-month low. Today's sharp sell-off driven largely by weakness in gold and rising bond yields. Here to explain why he thinks the market is overreacting is Royce Mendez, Managing Director, Head of Macro Strategy at Desjardins. Thanks for joining us today.
Thanks for having me.
You say the sell-off in the S&P, the TSX today looks overdone. Can you explain?
Well, just looking at the gold impact, it's huge on the TSX, not only today, but over the past few sessions. It's the main reason for the underperformance in the TSX versus other equity benchmarks. And thinking about that in a broader perspective, I mean, comparing this to maybe 4 weeks ago, it really feels like we live in a world of more U.S. policy uncertainty. We live in a world of more dangers, and so there are more reasons to own gold and gold producers than there were even just 4 weeks ago. I think one of the reasons that gold is being hit so hard is that it previously was one of the really big winners and is, one area where investors can sell their position and still realize a profit. And so you're seeing pressure on gold for those reasons, but maybe that's just a short-term sort of tactical trade. If you're thinking more long-term or even medium-term strategically, this might be an entry point if you missed out on that, 3 months ago or 6 months ago when gold prices were lower.
Okay, so do you expect a rebound in gold? And if so, a meaningful return for the TSX?
I think you should expect that gold is maybe in a temporary drawdown here, and then if we fast forward 6 months, and certainly if the acute part of this crisis with regards to the Middle East conflict is in the rearview mirror. You start to see global investors start to pile back into gold positions again, and by extension, piling back into TSX positions. I mean, one thing separate from the gold trade, has been that global investors have been really interested in putting money to work in Canada. And so gold has what's been really dragging on the TSX lately. But I don't think that overall theme of interest in putting money to work in a place like Canada, far from the conflict, a net energy exporter, I think that's a theme that is still intact. Right now, it's overshadowed by the drawdown in gold prices, but I think that too should prove to be eventually temporary.
Okay, let's talk about energy for a moment. We've seen oil prices, gas prices spike. I'm wondering whether you think this is only temporary and the inflation shock will be temporary. What if the conflict carries on? There isn't really an end in sight at this moment.
Yeah, look, I don't know how long the conflict is going to continue, or I don't have a forecast for how high oil prices will peak. But at some point, this is going to start to destroy demand. And that's going to be painful on the other side of all of this. And so I think if you're sitting here as a policymaker, what you want to do right now is just sit back and watch. Don't be tempted to go in and raise interest rates and chase oil prices higher. But also, you probably don't want to ease policy right now and maybe turn what is a localized, contained inflation shock into something more generalized. But let's say we're 3 months or 6 months into the future. And again, the acute part of this crisis is behind us. Even if oil prices aren't back to their pre-March levels, you could probably say that, the central banks, particularly in places like Canada, where inflation wasn't really that much of a problem heading into the conflict, you could probably say that central banks should really just look through this. Even if there's some lingering impacts on inflation for a little while after that, you don't want to chase that. You want to look at it as a one-time price level shift higher, and don't try to tighten policy. I mean, particularly in Canada, where the housing markets in Toronto and Vancouver are under real pressure, where the economy has not been growing at all over the last few quarters, and where population growth is basically stagnant. There's very few drivers of growth right now. You really don't want to come out on the other side of this and, maybe you see some lingering inflation and you try to chase that with higher interest rates. That's why I disagree with the market pricing over 2 rate hikes for the Bank of Canada for this year. I mean, even if this extends out for a few more weeks, I don't think the Bank of Canada on the other side of this is going to be chasing whatever lingering inflation there is with higher interest rates.
You think the U.S. Has a stronger footing right now. The circumstances are different. What's working there that we don't have?
Look, I mean, productivity growth has been incredible in the U.S. I mean, it's one of the reasons the U.S. economy is still growing. You don't need that much job growth if you're getting really good productivity growth to get overall the economy moving in the right direction. The other thing that is different is not such a great development in the U.S. It's on inflation. I mean, GDP growth has been good in the U.S., but inflation has not come down as much as it has in a place like Canada. You heard from Jerome Powell yesterday, and he sounded very frustrated with the stickiness in core and what some people call super core inflation measures. And that means that the Fed is in a bit of a different spot. I mean, where I say the Bank of Canada can really easily look through this because the economy is weak and inflation is low here. The Fed, the unemployment rate is pretty low. I mean, the economy looks pretty solid in the U.S., and inflation is starting from a higher point. I think you have to look at the Fed and maybe some central banks in Europe in a very different light than you look at the Bank of Canada. But the Bank of Canada is just being caught up in this huge sell-off in fixed income markets today.
Horace Mandan's got to leave it there, sir. Thanks for your time. I appreciate it.
Thank you.
Shares of Micron taking a hit today after the chip maker gave a forecast for capital spending that was higher than expected. The latest example of investors being wary of elevated spending. More in a moment. Micron shares down 2%. They're under pressure even after the company reported a quarterly profit that nearly tripled as demand continues to outpace supply. For more on why there was a sell-off today, we're joined by Grant White. He's portfolio manager and investment advisor at Endeavor Wealth Management.
We've seen great reports and other AI-driven stories, recently, and so I think this is largely profit-taking that's coming off the table. I mean, obviously, we understand the environment that we're in. There's a lot of volatility out there. There's a lot of uncertainty out there, and you've got a company here that's up over 350% or so over the last year, or 325%, as you're pointing out here. So I mean, I think this is a lot of profit-taking, but we still really like Micron. I don't think that the story is anywhere close to being over for this company yet. We've got at least a couple years worth of catch up in supply related to memory, and as long as we're not wrong on what AI is the build out's gonna do over the next few years, I think Micron is gonna do very, very well. So I think that ultimately what you're looking at here is potentially a buying opportunity. It's not that the company's cheap per se, but the growth story is certainly there, and there's a lot of wind still in their sails.
It seems to be, Micron talking about high spending in the next couple of years. Is this just some concerns as well from investors in terms of all this excessive spending we're seeing from these big companies?
Oh, certainly. I mean, I think the story is really turning into what's going to be the ROI on this big spend that's going on, right? And we were seeing companies spending hundreds of billions of dollars on new build outs and so on. And so, yeah, I think naturally the story has to shift to that. Now, I think this is overblown in the case of Micron in particular, because I mean, frankly, there's only a few players in this game as it relates to memory, and there's a long way to go before they're actually able to meet up with demand. And so I think the story is long. I think the spend out is warranted, and I think that that Micron's going to do very well in it. But I do think you're touching on a broader story that we do need to start looking at the spend here on a lot of companies and wondering, is the ROI going to be there?
Yeah, it's an interesting conversation as well in terms of people's patience, in terms of seeing that ROI. I know you have some stock picks. I do want to get to those, but first, just kind of looking at the broader market, it's been interesting, to say the least, over the last couple of weeks or months. You say you think markets can move higher from here, but not in a straight line. So what do you mean by that?
Yeah, absolutely. I mean, I think to say it's been different in the last little while is an understatement, obviously, with what's going on. And so, what we expect here is lots of volatility, and that's exactly what we're seeing. We're seeing lots of ups and downs. I think we're going to be a bit range bound at some point here pretty soon, until we get a little bit more certainty about what's going on. But I think that the markets, there's a lot to like about these markets too, and I think that despite the atrocities going on, what you need to look at is the buying opportunities that are being created here. So focusing on fundamentals, there are some great companies that were frankly just overpriced and were really difficult to get into not too long ago, and we might be seeing a buying opportunity here because the fundamentals behind them were strong before. We just didn't have good pricing, and so I think this is going to create an opportunity. But you got to be very aware that the next few months are likely going to be quite volatile, and so being willing to take the lumps is probably going to be necessary in order to do well in this.
Okay, so let's go through some of your picks. Strathcona Resources, what is it that makes this stock interesting to you?
Well, I think they're like primed in the story here. I mean, I think that one, they're a great producer. We love our Canadian producers, and I think that they're really well positioned here to do well. Obviously, with oil prices higher, they should do quite well in that. And what they've been able to demonstrate though beyond that is that they're great managers. They're great. They've been really able to manage their costs. One of the things that we like, I think the understated story here is also the share buybacks that I think were recently announced. And so, if you look at their dividend yield, if you add their share buyback yield, I mean, I think you're looking at about an 8% yield per shareholder around there. So just to hang on to this thing, you're getting about 8% yield overall. So long story short is I think the story is really strong. I think they've been great allocators, and you're getting a really nice yield. They kind of wait for it. Also,
CNX Resources, another one that you like. Why do you like this company?
CNX is a great story as well because, I mean, again, they're really playing into the story of like energy here, obviously with the natural gas producer. But what makes CNX really unique is their ability for cost control because they own part of the pipeline. They own the midstream part, and so they're really able to manage their costs better than a lot of their competitors will, and also their direct access to market. And so, long story short on CNX is that they're just way better positioned than most other energy producers to manage their costs. So when natural gas prices are kind of normalized, they do well. When natural gas prices rise, they do really, really well. And so they, I mean, it's just a really great producer that, again, I'd hold it up against any of their competition just because of that cost control.
And Constellation Software, another company that's been on the rise a little bit as of late. What is it that you like about Constellation Software?
Well, I think that the SaaS like being blown up story is overblown. That's the thing. I mean, I think that what we're starting to see in the AI story now is that you need the rubber to hit the road. And I think Constellation is a company that's going to have the rubber hit the road really fast. And largely that's because of their ability to integrate AI into a lot of their systems or a lot of their software systems that are already out in the marketplace. So I think they're going to do really well in that. But this stock's been beaten up, as we can see over the last little while, over the last year, because everybody thought that software was dead for a while. And I just think that's not the case at all. I think that if anything, AI is going to be used to enhance their offering and what they bring to the table. And Constellation's demonstrated for decades that they have the ability to manage through storms, and they have the ability to acquire great companies. And I expect that's going to continue on. They didn't become bad managers overnight. So I think that's going to continue on. And in fact, I think AI is going to enhance the story. They're going to get they're going to be able to reduce their costs, improve their margins on their existing product line. And they're going to do very, very well.
And lastly, Thrive Holdings. Shares are climbing today, and you have a buy on this stock. So what does it like about Thrive Holdings?
Well, Thrive's kind of the same story, actually, as Constellation. I mean, this is, for a lot of people that don't know this is like a legacy Yellow Pages business. But what they've been doing over the last, well, we'll say a little while, but over quite some time now, is converting Yellow Pages customers into software customers using, and then what they're targeting is, this is not competition to companies like Salesforce or Microsoft. They're targeting like small and mid-cap type companies that really can't afford the services that like a Salesforce would provide. So they're in a really great market space, and they're converting over to like CRM systems and software systems that will help them to improve their business and data mining. And again, the company largely been beat up, I believe, because of everybody thought software is dead. But I think that Thrive's going to do a really good job of integrating AI solutions into their technology. And so I think they're far from dead. I actually think the story is just starting, and they're actually going to be really improved over in the coming years. So I think this is one to watch out for.
Grant White, portfolio manager, investment advisor, Endeavor Wealth Management. As the conflict in the Middle East wages on, NATO Secretary General says it's a lesson in ramping up defense production in a cost-effective way. More in a moment. Bernadetta Berti, Secretary General of the NATO Parliamentary Assembly, says NATO is learning many lessons from both the conflict in the Middle East and Russia's invasion of Ukraine. One lesson is on the need to surge production of defense capabilities in a cost-effective way. Berti spoke with our Bloomberg colleagues.
Well, I would say NATO has not been involved militarily and otherwise in the U.S. And Israeli operations against Iran. But what NATO has done is continue to serve its core purpose, which is to ensure the security and defense of all allies. And in that context, as you know, NATO has successfully intercepted multiple ballistic missiles that Iran launched towards NATO ally Turkey. So that is clearly the priority. That said, the NATO Secretary General has also been very clear that all allies share an interest in having an open Strait of Hormuz. And in that context, there are conversations between different allies on how to best contribute to that goal.
I mean, President Trump again said there would be some kind of consequences if NATO weren't to get involved more, and then he walked back those comments. Do you think there will be, if not retaliation, a consequence for the alliance if they don't get involved?
I think within NATO, the conversation over the last couple of years has been very clear, and that is about European allies doing more and taking a leading role for the deterrence and defense of the European continent in NATO. That is what we're focused on. We're focused on that by meeting the 5% defense spending plan, by enhancing defense capabilities, and of course by making sure that no ally is threatened, for example, by intercepting this reckless Iranian attacks against Turkey.
I also want to talk to you about Ukraine, because there's been, of course, U.S. weapons purchased by Europe, and then, for help in Ukraine. Have those been delayed or affected by the war in Iran?
So I would say through NATO, through the Pearl initiative, NATO has been supporting individual allies to purchase life-saving interceptors, including Patriot missile systems, from the United States to Ukraine. And over 75% of those interceptors provided to Ukraine have been purchased through Pearl. So this program is working. Yeah. And I think just very recently, President Zelensky talked to NATO Secretary General Mark Rutte about enhancing what we do in the context of Pearl. So clearly that commitment remains from all NATO allies to support Ukraine.
And you don't see any change going forward because some of the weaponry that the U.S. were selling to Europe is needed for the U.S. combat in Iran?
I think there's many lessons that we're learning from the war in Ukraine and also from what we're seeing in Iran, and that is the importance to really scale and surge productions. And we do have that issue. We do know we need more interceptors. We also need to find cheaper ways to shoot down drones. So we do know that there is a cost asymmetry that you need to address. I think we are doing that. And of course, when there are multiple threats and challenges, there is a problem of how do you surge production.
How do you do that? Again, so where are the sources where you could diversify or have, anti-missiles and anti-drones that are cheaper?
So there are many things you can do. Firstly, within Europe, we need to continue to invest more in defense so that we send a demand signal to industry that this is not a temporary blip, this is a sustained demand, so they can expand production. And when we do that credibly, it works. Look, for example, on ammunitions. We see that we've been able to incredibly six-fold increase in just a couple of years of production of ammunition. So we need to do that. We need to invest more in sensors. Some of those are commercials. We can field those relatively cheaply, and those help us to better intercept drones. We can invest in energy laser weapons. There are ways to intercept drones that are cheaper. And then we also need those higher-end capabilities like high-end interceptor, the Patriot system to ultimately intercept ballistic missiles. But we need to diversify, invest in innovation, and make sure that we address this cost asymmetry.
Benedetta, are European nations and Canada doing enough actually to make sure that Europe is able to defend itself better without the need of the U.S.?
They're doing more, and that's without a question. We still have a long way to go between now and when we get to that 5% for all allies, and between now and when we get to have all the capabilities that we need to have European allies in the lead for the conventional deterrence and defense. But it's happening. We see more forces, more capabilities, gradually also more strategic enablers, but there's no question there's a gap.
I was going to ask you exactly about that. Where are those critical gaps?
There's a few. For example, when it comes to the integrated air and missile defense, we know that Europeans, a year ago, the Secretary General of NATO said we need a 400% increase in European capabilities. Now we need a little bit less because we have purchased, but there's still a long way to go. So there's a shopping list that is pretty detailed. I would put integrated air and missile defense, deep precision strikes capabilities up on the top.
And given everything that's going on, is that list being looked at more intently? Do you think there's a bigger will in a way because security around the world has gotten a lot more uncertain?
I would say that's certainly the case. There's more political will, and we see that translated in more defense spending, but there's also more awareness that we need to be more disruptive, more integrated, emerging and disruptive technologies. We cannot just keep doing things the old way.
I mean, are we running out of weapons because so much is being used in Iran?
I wouldn't say we're running out, but I see this is a clear signal that we need to seriously invest in our ability to surge and scale at speed, because in the future we're going to have to outproduce and out-innovate any potential adversary.
That was Benedetta Berti, Secretary General of the NATO Parliamentary Assembly. Let's take a last look at the markets ahead of the end of the trading day. Another dismal day on the markets. TSX down the most today, 1.4%, 460-point drop. We're back in a moment. Here are the closing bells for the end of the trading day. At the Nasdaq, Rank 1 Computing ringing the closing bell. In New York, Xylem ringing the bell. And at the TSX, TC Energy closes the market in celebration of more than 65 years of being listed on the TSX. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. Markets were deeply in the red today, while the TSX was, as surging oil prices continued to ramp up the pressure, which the Iranian war carrying on. Investors are pulling back. The TSX down 1.4%. The S&P, not a material change, but the Nasdaq down 61 points today, about 1/3%. Let's have a look at where oil is right now. West Texas Intermediate is actually down $1.44, so 94.88 is where we find it at the end of the trading day. Let's get to the movers in Toronto. Precious metals were falling again. So Endeavour Silver was down $1.07 or 8%. B2 Gold also dropping over 8% today. And then Equinox Gold also gaining today, so it moved to the other direction, a gain of $1.54. Let's get to the Canadian. Okay, Equinox Gold, we're showing here again down 7.5% or $1.39 down to $17.03. All right, energy surges here. 1983 is where Vermilion Energy landed. That's up 14% on the day. Suncor up 2% or $1.88 to $87.01. And then CNQ, Canadian Natural Resources, gaining close to 3% or $2 a share to $69.50. Micron Technology falling today over 3%. The company announced plans to increase capital spending. So that is weighing on the stock there. And then Meta edging lower after news it's canceling its metaverse initiative. So that sent the stock down 1.6%. Rivian posted some gains today. It's up 3% after announcing a $1.25 billion deal with Uber. So as mentioned, Meta stock dragging today after news that the metaverse is getting a reality check. Let's go to Doug Clinton, founder and CEO of Intelligent Alpha. He joins us now. Doug, metaverse was a money sucker, billions for years. Still, are you surprised Zuckerberg's finally pulling the plug?
You know, Merle, I'm not really surprised at this point. I'm actually surprised they didn't pull the plug earlier. And specifically what we're talking about for this product is a virtual world, really, that they developed called Horizon several years ago, really very limited user base. And so in many ways, I think it's actually surprising they haven't done something sooner here. Bigger picture, though, if you think about the Reality Labs segment, it is an astonishing amount of money they still invest there every year. Last year, 2025, they burned about $20 billion on that segment. To put that into context, they'll spend somewhere around $120 billion in CapEx this year. That was their guidance. And so, call it, 15, 20%, right, of the CapEx they're spending on AI they burned last year in Reality Labs. I think you could see more cuts in addition to this one.
Interesting. Okay, so should investors then read it as a red flag or simply a transition?
I think it's a transition. I don't think it's a red flag. Really, if you think about Meta's business, very little impact on the positive side, unfortunately, from the Reality Labs segment, other than the Oculus headset, which they are leaders in VR for. It's a pretty limited market. It's just kind of a money-losing component to their business. So I don't think it matters from a stock standpoint. I do think, again, there might be more leverage there that they could kind of free up to continue to spend on the AI side, which they will be aggressive on.
Okay, let's talk about the Uber deal with Rivian, investing in robocars. First of all, what do you think of the partnership?
Also not surprising, I would say. If you look at what Uber's strategy has been since they shuttered their autonomous group several years ago now, they've gone out and they've inked a number of partnerships. So Rivian today, they have a deal with Lucid as well. They've worked with Waymo in the past. And so I think they've kind of approached this this market as almost like kind of a Switzerland, right? They want to be a neutral party in terms of the hardware and really bring that customer demand. And so it is a pretty big deal. I think more so probably for Rivian than it is for Uber. But I think you could continue to see Uber make more and more of these deals with providers in the market so that they can maintain this sort of leadership in terms of being the demand side and then bring that supply from all the autonomous providers into it.
It does make sense, but then you don't think that this would be an exclusive partnership. Uber will be able to go out there and partner on another different car makers or vehicle makers?
As I understood the announcement filing, I believe it is actually exclusive on the Rivian side for some period of time. So Rivian is kind of locked into using Uber as a distribution partner for autonomous taxi. On Uber's side, though, as I said, I believe they probably still are free to go and work with other partners. And I think they have a plan with Lucid to be launching some limited robo-taxis later this year using their cars.
All right. I know you use AI to help manage portfolios. Does it come up with opportunities that you think people miss?
It does. Often. And there's, I would say, maybe two angles that we've been focused on more recently, both of them involving AI. One on the power side. Maybe it's hard to say that anybody's missing anything in the AI trade because it feels like one of the things that's worked so well over the last year or two. But I actually do think investors are still missing the reality that power remains a critical constraint as we think about the demand for AI and the data center buildouts that these hyperscalers are investing hundreds of billions of dollars into. Power will continue to be an issue, and making sure that they have enough power, I think, will be a growing focus for the hyperscalers. We've seen them do deals with companies like Vistra and Constellation. I think you'll see more and more of those deals as they've sort of committed to really powering these opportunities themselves. So Vistra is a name that we do own in our GPT ETF. I think that one can continue to work. Same with GE Vernova, which creates turbines that help to help power generation for these data centers.
Okay.
The second one I would mention is on the software side, where our models at the end of last year kind of got more bullish on software. Software had been beaten up in 2025. Unfortunately, I think we were early. Software got even more beaten up this year. We've had a little bit of a reversion more recently, but our models are kind of souring a little bit more on that trade now. We do own ServiceNow, and I think if you're looking to play that space, you do want something like a system of record to give you a little bit more stability than something that's not as embedded in the enterprise.
I was going to ask you, what are your parameters for software right now, considering how much they've pulled off?
It's so tough, Marilla, because it's not really, in my opinion, about vibe coding. I mean, we are totally embedded in using AI in our business at Intelligent Alpha. I think the real challenge for software companies going forward is actually this move from human-led workforces to agent-led workforces. And if you think about a business that's run maybe entirely by agents, they just have different demands than what a human business has demand for. And so if you think about it from the perspective of like a CRM system or a workflow management system, these are things that are really built for humans. They're built with humans in mind and how we need to sort of track our activity. When you're dealing with AI agents, they naturally track all of their activity. And so the use cases, I think, change fundamentally. And because of that, I think it's just very difficult to get comfortable underwriting sort of long-term value for a lot of these software companies right now.
All right, I do have to leave it there, Doug. Thanks for joining us. Doug Clinton, founder, CEO, Intelligent Alpha. Rising energy costs hitting some small businesses hard. Why confidence is sliding. Back in a moment. We have earnings coming in right now from FedEx, which opened 2026 on a tear, rising on rosy views of the American economy, but the war in Iran poses a threat to growth. So here's the third quarter results. Adjusted earnings per share coming in at $5.25 versus $4.51 year over year. The estimate had been well under that at $4.17, so quite a beat on adjusted earnings per share. Revenue coming in at $24 billion, that's up 8% year over year. The estimate had been just under at 23.49 or 23.5. Federal Express revenue coming in at $21.1 billion, that's a 10% increase year over year. The estimate had been 20.6 or 20.58 billion, so a beat in that revenue. FedEx Freight revenue coming in at just under $2 billion, and that's down almost 5%, 4.7% year over year. The estimate had been at 203. They are planning a spinoff of FedEx Freight. Here's the forecast for the year. They see adjusted earnings per share coming in at $19.30 to $20.10, and the estimate had been $18.71 from Bloomberg, so that is well above that range. And they see capital expenditure up to $4.1 billion. The estimate had actually been higher, $4.31 billion. So that's capital expenditure for FedEx, the delivery service. Small business confidence in Canada taking a sharp hit as rising fuel costs and persistent demand weakness weigh heavily on outlooks. For an in-depth analysis on the issue, we were joined by Andrea Bourgeois, Director of Economics for CFIB.
their optimism plummeted in March. It's something that we've been monitoring for years, so it's not just, oh, it just happened, it's a bad month. So that is very, very concerned. They don't have these composite indexes and all this optimism for them. It's about, if I feel good, I feel strong about my business, I'm going to invest in my people, I'm going to have new products, new services, and I'm just going to expand. I'm not optimistic. I'm not going to do any of those things. And then those things, they reflect in, macroeconomic indices. The first thing that is way on their mind is fuel costs. We have seen this indicator increasing sharply in the month of March. Is it at the top? It can be, probably not. But it's one of those costs that affects every industry and every type of business.
And that may only get worse. How concerning is it that we may not have hit bottom yet with that?
It is very concerning. Right now, this indicator stands at 50% of concern, which is one of the highest levels ever. And, if this goes up, it will trigger impacts on supply chain. The other indicator that has risen sharply in March was input product costs. Small and medium-sized businesses, most of them are local, but it doesn't mean that everything that goes into production is local. They still depend on imports. They still depend on, products and raw materials coming from somewhere else. So fuel costs are number one on their horizon. So these two costs were really making a huge impact on their optimism level.
And with that confidence index, what's the worst it's ever been, and when was that?
Oh, that's a very good question. The worst it has been easy to answer. It was actually March of last year. So unfortunately, the fear of tariff was so strong that optimism plummeted at the lowest level ever, 25, in fact. And, just a parenthesis, an index basically goes from 0 to 100. It would be 100 if everyone would be optimistic. The highest we have seen it was in the high 60s when the economy was growing. That is back, before the 2015. So that's quite a while since. It has been a bit challenging, obviously, since the pandemic. It has dropped around, the 30 point during the pandemic, and then the tariffs made it go even lower than that. And it was the long-term optimism that was affected the most, exactly a year ago. It has been gradually increasing. And actually last month, it would have been a really positive discussion about it because small businesses have seen a glimmer of hope. And then it was too soon to speak about optimism long term because this month has proven to be very challenging and it took a turn towards the worst. It's still above the 50 point. And I say the 50 point in the sense that everything below 50, in fact, we should talk about pessimism. Everything above, it's very modest optimism, but is not showing that the economy is or can be growing at its potential.
And I guess, and you mentioned off the top about the people hesitating to do anything right now. And the danger, I guess, of that is even when things do start to turn around, will it take a while for them to get started on things, or will they be trying to play catch up then as well?
Absolutely. We're seeing very slow adjustments. For example, one of the indicators we're watching is employment changes. Everyone watches that. But small businesses are particularly busy during the summer, in Canada and in a lot of other states. And that indicator, usually we see a pickup this time of the year. Well, it's very modest for March. It has, the chance of increasing later on. But this is where you see that if they're not looking to increase their labor force for the next coming months, they probably don't expect a stellar summer. Therefore, fewer services, fewer products, shorter opening hours. So in other words, they actually expect lower revenues for the months to come.
And finally, I guess it's a positive. Are there any sectors that are benefiting from this situation or taking advantage of the situation?
The sectoral picture is usually a bit more mixed. Some sectors are doing better than others, and I think it's normal. The sectors that are usually dealing mostly in services and would rather serve, customers instead of other businesses, they tend to be still on the optimistic side. If you think of the health sector and everything related to that, some of the other sectors, professional services, those are a little bit more sheltered, from fuel cost, input cost. But it doesn't mean that they're doing great. And, the economy cannot grow even despite two sectors being very optimistic. Where we see at the other end of the spectrum is construction being affected, manufacturing, transportation, agriculture, those sectors that depend on fuel costs, that depend on input products.
And how are they doing right now in comparison?
They're rather pessimistic. They're not that they're rock bottom, but they're not really in an optimistic position. They're not in an expansion thinking. You see their business owners being more cautious about the future, and just if you're not planning for higher revenues, you're not going to plan on higher expenditures either.
Andrea Bourgeois, Director of Economics for CFIB. Coming up, hot picks, 3 plays in the retail sector when we come back. Time now for Hot Picks. We zeroed in on the retail sector. Our guest was Stephen Zacconi, Senior Analyst in Equity Research at Citi. And we started with his first pick, O'Reilly Automotive.
Consistency in the auto parts retail space, one of the best executors in all of retail, right? Auto parts retail is a great defensive subsector in the retail backdrop. It's a needs-based category, right? In the midst of kind of higher interest rates and consumer, tightening budgets, you're going to have to continue to repair your existing vehicles. So this business really serves that kind of sweet spot. And you think about the opportunity for market share gains, they've been the big market share gainer relative to some of the independents and some of the other players in the space. But O'Reilly is really best in class when it comes to the auto parts retail segment.
Is there any downside risk to your buy rating on this company?
Yeah, we're in the midst of a very macro tape, right? Like obviously, oil prices are up, right? What does that do to the consumer? We've published extensively here about, gas prices and the risk. Like we actually had a bunch of companies at our conference last week in Miami. We had 60 in total. O'Reilly was one of them. And, there's a lot of uncertainty, right? The key factors are, how long does the conflict last, right? We've seen this initial shock. We're really paying attention to what happens with consumer traffic trends and spending. So that is a risk if the consumer takes a leg down. But when you think about who are the more defensive businesses, auto parts is a relatively needs-based transaction. So I think they would be one that screens more defensively relative to some other discretionary purchases in retail.
Next hot pick is one I think a lot of people are familiar with, and that is Home Depot. What is it you like about this company right now?
Yeah, I think, if we start with the market backdrop, right? Like we've had a pullback in a lot of the housing exposed names within the last, month to 2 months. There was a lot of optimism coming into the year that we're going to start to see rates come down. I think you look at the opportunity here with the sell-off in this macro tape. This is your opportunity to lean into some of the better quality businesses that have a little bit more cyclical exposure. I'd put Home Depot right up there, right top of the list. You think about home improvement spending has a lot of pent-up demand for the next couple of years. It's been very difficult to call the exact timing, but we've been in this period where, housing turnover has been weak. People have been delaying some of the spending on the home. As you start to see housing turnover improve at some point in the next couple of years, Home Depot is really the best way to play that in our view. You've got the exposure to the DIY customer. You've got the exposure to the large pro. They're doing some acquisitions to kind of build their capabilities. So, I think you're definitely kind of defending the weakness here in a Home Depot if you've got a longer term time horizon.
It's so interesting. Like I'm assuming some of the key risks for Home Depot, like for this company, is in correlation really with the housing market and how the housing market is doing in Canada. Is that right?
Yeah, U.S. more importantly, but yes, rates matter for housing turnover, right? And what matters, housing turnover really drives people doing large project activity, and that's kitchens, baths, flooring. That's the area of the market that's been, weak. We've seen engagement get better in the home, but you really need, the unlock of kind of turnover for some of that project activity to happen. So, I think great business in terms of protecting profitability. If sales come in a bit weaker, there's no real concern about margins being at risk at a business like this. It's just top line environment could be a little bit weaker, but I think that's a buying opportunity in the longer term view of the business.
For sure. Okay, your last pick is Tractor Supply Company. What is it you like about this one?
Tractor's a unique one, and it's topical in the sense of oil prices going higher. If you're looking for retailers that tend to be a beneficiary from higher inflation, Tractor hits that. They sell some oil-based products, right? So think about lubricants and stuff of that nature. They have some exposure to, they have higher exposure to the domestic regions in the United States where you'd see oil production pick up, and maybe that helps the local economy. So that's a Texas and an Oklahoma. The other factor is, they really have a dependence upon commodity inflation. So think about corn, grain, they sell a lot of livestock feed. Those are leading indicators for kind of inflation in their business. The fact that oil has gone up tends to be a leader for commodity inflation as it relates to their business. So they look like a net beneficiary. Now, I think they're still a second derivative housing play. So you'd like to see housing turnover improve. They have exposure to the pet category, which feels like we're at a point that trend should start to improve in 2026. The last couple of years, sales have been weaker, but I think it's a good quality business. They've got great control over the operating margin from here, and it's another one where this weakness is probably a buying opportunity.
It seems as though, the retail sector as a whole has been pretty resilient to tariffs over the last year or so, absorbing those costs as much as they can too. We're starting maybe to see a shift in terms of consumer spending, like consumer pullback in the retail sector as a whole. I wonder if that concerns you at all for the sector moving forward.
The tariffs, we've been able to pass on some of the pricing, right? Mm-hmm. And we're probably at peak in terms of tariff pricing, second half of 25, really now first half of 26. And largely speaking, we've been able to pass it on to the consumer. We haven't heard a lot of retailers have margin issues, right? I think the concern for retail and the consumer now, you have a prolonged conflict in Iran. Oil prices continue to stay high. What does that do to the health of the low-income consumer? What does it do to the propensity for, consumers to kind of spend on big ticket goods? It's a difficult environment right now, because if we get a resolution tomorrow and oil comes back down, it's a several week phenomenon that kind of goes away, and you start to see a recovery in terms of consumer confidence. But if it lasts longer, it is something to monitor for the health of the consumer.
Stephen Zacconi is a senior analyst, equity research at Citi. Up next, the CEO of TC Energy joins us to talk about missed opportunities in that sector. Back in a moment. The restrictions in the Strait of Hormuz have forced nations to look elsewhere for energy. Canada is one place they've been turning to. But many say our lack of infrastructure and slow approvals process for building new infrastructure adds up to missed opportunities. Our next guest has spoken about that. Let's go to Francois Poirier, Chief Executive Officer at TC Energy. Thanks for joining us today.
My pleasure.
The Prime Minister has committed to a 2-year timeline to get projects approved. As you know, you say even that is too long.
Yes, I think when you're competing on the global stage, customers aren't going to wait when they need to contract for LNG. They're not going to wait for any particular country who could supply their LNG to finish their regulatory process. They're going to sign up for that capacity when they need it. And of course, with the geopolitical situation that's going on, there's certainly a sense of urgency around securing LNG from different parts of the world to diversify their sources of supply, and of course look for paths that avoid the Strait of Hormuz. So being a bit more outcome focused, being a bit more focused on the time-bound nature of the opportunity, I think is really important.
How long does it take for some other countries to get major projects approved?
We can just speak to our own example on our Southeast Gateway pipeline in Mexico. From our original application to receipt of our full permits was 7 months. It was a project of national priority. We certainly didn't cut any corners in terms of environmental assessments, in terms of consultations with landowners and indigenous groups. And another example would be in Germany, when the conflict in Ukraine broke out. They went from concept to actually a regasification facility to receive LNG being put entirely into service in about a year and 2 months. So there are examples of countries being able to do this.
Okay, you've remarked about the demand and how much it's increased since the start of the conflict in Iran. How much more gas could you export if the infrastructure was available today?
Well, right now we're only moving about 2.5 billion cubic feet per day through the LNG Canada facility. Of course, LNG Canada is contemplating a doubling of that capacity to 5 BCF a day. There are 2 other projects that are looking to get built for LNG export, which would add about another 2.5 billion cubic feet a day. But I think we should aim high. Let's be the largest exporter of LNG to Asia, and that would be in that sort of 12 BCF a day range. The resource is there in the Western Canadian Basin. We have the know-how. We have a delivery advantage from the west coast of Canada to ship to Asia. It's a much shorter distance. It's about 8 days shorter than shipping from the Gulf Coast of the United States. And let's go after the business.
Is it worth investing now? Are we already too late? Does Asia have elsewhere to turn?
Well, this opportunity has come back around to us a second time, which is why I'm really making an effort to speak to this opportunity again. 15 years ago, we were at the start line of the LNG export business in North America with the U.S. Neither one of us had any export capabilities. If we were playing a hockey game right now, the score would be 8-1. We have 1 facility that's been commissioned and in service. The U.S. has 8. And they are the largest exporter of LNG in the world. I thought the opportunity had come and gone, but because of geopolitical tension, because natural gas has emerged as the fuel of choice around the world to balance affordability, reliability, and sustainability, the opportunity has come back around for Canada to punch above its weight, which will help us, of course, grow our economy. It'll help us diversify our economy away from the United States and create wealth for Canadians.
I wanted to get you on data center build out, the hyperscalers building everywhere. Does TC Energy have any direct contracts related to that build out, either in Canada or the U.S.?
We tend to focus on serving the utilities who in turn take the gas that we deliver them and generate power, and they're the ones who've been selling power to the data centers. Nevertheless, we've seen quite a bit of growth opportunity in terms of building out our pipelines to serve the utilities, who in turn are serving the data centers. And we see ourselves investing perhaps up to another $10 billion to serve that market over the next few years.
Okay, let me also ask you about Bruce Power. I know there was consideration of expanding the facility there. Is that still on the table?
Very much so. Right now, we're in the middle of the refurbishment of the 6 existing units, and we've been very successful in bringing those in on time and on budget. Ontario definitely needs more nuclear capacity, and we're very interested in speaking with the Ontario government about expanding Bruce Power to deliver an additional 4,800 megawatts.
Okay, let's talk about the focus for 2026. We've talked about a number of different points, what we need to build, where we can get the product. What would you say is the company's overall focus for 2026?
Well, our focus on 2026 always begins and ends with operating safely. But beyond that, we feel there's an opportunity for us to sanction even more growth projects in Canada. We're seeing an awful lot of growth and investment opportunity in the United States, and it's attracted most of our capital over the last few years. I'd like to see us investing more in the Canadian marketplace, expanding our system in Alberta to allow gas to get to more export points and see better pricing in the Alberta market for our producer customers.
Francois, I do have to leave it there. I'm out of time with you, sir, but thank you for your time. Francois is Chief Executive Officer at TC Energy.
My pleasure.
Coming up next, the Japanese Prime Minister in Washington for a meeting with Donald Trump. More in a moment. The Japanese Prime Minister Sanai Takaichi met with the U.S. president today at the White House. It comes at a sensitive time when Japan has refused to police the Strait of Hormuz as demanded by Donald Trump. Let's go to Kurt Tong, managing partner at the Asia Group. Kurt, thanks for joining us today.
My pleasure.
Trump, does not like to hear the word no. Can you expand on how Japan could explain this to the American president?
Well, with respect to the Iran assistance question, for several days prior to Prime Minister Takaichi's arrival, the president was telegraphing that he was going to make a big ask of Japan for military assistance in the Strait of Hormuz, which is a very difficult thing for Japan to do, either politically or legally. And the Japanese responded quite appropriately by taking the issue offline rather than debating directly with the president through the media. They put together a communication channel between the defense ministers, and the two sides sorted out what Japan can do, which appears to be to essentially endorse diplomatically the efforts that the United States is making to enforce the non-existence of a nuclear weapons program in Iran, endorse that goal, and then offer support in rather vague ways that could result in material support later, but not in the immediate term.
Okay. Would Japanese citizens support an initiative at all as far as policing the Strait?
I don't think they would. And I think it would be both legally and politically very, very difficult because of that lack of public support. The Japanese public attitude is essentially one of you broke it, you fix it, which is similar to the attitude in Europe, but the Japanese government stepped in between, and rather than get into a debate with the United States about the merits of the war, have said, Prime Minister Takaichi today was quite forward-leaning, saying that she trusts President Trump to do a good job, but then with that as cover, then did not offer anything specific in terms of material support, which is, I think, the Japanese public's reaction to this is going to be quite positive, that they essentially dodged a bullet.
There are U.S. troops stationed in Japan. If Trump threatens to pull them, what would that mean for Japan?
Well, that would be an enormously upsetting circumstance for Japan and really make fundamentally alter their defense strategy. They would need to reconstruct their defense strategy from scratch and become much more self-reliant. I don't think that's going to happen. I don't think that's even remotely possible, actually.
Okay. Is there tension between these leaders over Taiwan as well?
Well, the Japanese prime minister got out a little bit far in front in saying more directly than usual that a Chinese attack on Taiwan could maybe require Japan to respond somehow in its own defense. China decided to be very upset about that statement and has subsequently been bullying Japan with some economic sanctions, travel bans, a ban on fish, some export limitations on critical minerals, which has made Japan quite worried and in need of U.S. moral support and diplomatic support. President Trump, meanwhile, is pursuing commercial agreements with China through bilateral negotiation and doesn't want to upset that process by being too supportive of Japan. So it's a balancing act. The two of them, in that circumstance, handled it quite well today, I think. Prime Minister said that Japan is a steadfast ally of the United States, maintaining peace and stability in the Pacific, and that she expects the United States to do the same. President Trump, in turn, said that when he goes to Beijing, he'll sing Japan's praises, which is a very vague formulation, but quite positive in saying that he would not sort of sell Japan down the river in his discussions with China.
Okay, I do want to get you on one last issue, and that's tariffs. I'm wondering if there's still a concern for Japan, especially with vehicles that go to North America.
Yeah, I think Japan's expectation is accurate, and their expectation is that at the end of this process of replacing the tariffs that the Supreme Court found illegal with new tariffs under Section 301, that Japan will essentially get the same deal. And so they're very intent on making sure that their autos tariffs in particular are the same level, 15%, that they negotiated very carefully with the United States over the course of many months. I think that's achievable. I think they'll get that deal, but they're going to be watching it like hawks to make sure that there's nothing untoward there, because it is very, very important to the Japanese economy to making those exports.
Are there any other areas of cooperation these two would discuss?
Well, a big headline issue for the two sides is this memorandum of understanding they have, whereby the Japanese government is going to make major investments in infrastructure in the United States. Most of that seems to be headed towards energy infrastructure. So later today and also into tomorrow, expect to see more specifics about Japanese government financing, essentially concessional financing, for energy projects in the U.S., mostly in natural gas and in nuclear power, which is a nice boost to the industry in the U.S. It also creates export opportunities for Japanese suppliers into those projects.
All right, Kurt Tong, I'm going to leave it there, sir, but appreciate you joining us on this topic. Kurt's a managing partner at the Asia Group. Thanks for that.
Thank you.
So pretty difficult day for miners with drops in gold, silver, wiping out gains we saw at the start of the year. We'll take another look when we come back.
By lies of fast cash.
What did you think was in the bag?
Trapping young Canadians.
She's a 19-year-old girl.
As unsuspecting drug mules.
People pay a lot of money for cocaine.
W5 goes deep inside Hong Kong.
There are 4 Canadians in prison right now.
To uncover a crime syndicate.
She wants us to expose these people.
Hunting for traffickers.
They just asked me to find people for them?
Here at home, W5's Avery Haynes investigates. Saturday at 7 on CTV and Crave.
Rough day for miners as big drops in gold, silver, and industrial metals are wiping out the gains seen at the start of the year. For more on the sell-off, let's go to Bloomberg's Michael Regan. He joins us now. Michael, this looks like an across-the-board sell-off. What do you think is driving it?
Yeah, it really was. I mean, I'm looking at the MSCI Global Metals and Mining Index, 36 of 37 companies in the index down today. I think it really shows you the two main economic risks of the war in Iran. One is obviously this higher for longer crude oil price, which is stoking inflation concerns. That's pushing back any hope for interest rate cuts in the U.S. and elsewhere further and further back. And that is really not a good recipe for the miners of the precious metals, you know, the gold and silver miners. At the same time, it's also stoking a lot of concerns about economic growth because of those high oil prices and all the other disruptions going on because of the war and the closure of the Strait of Hormuz. So that's really the story for the industrial metal miners, you know, the copper and not even necessarily just the miners, but the aluminum, steel producers, that sort of thing. So it's really kind of the two sides of the coin as far as the economic impacts of this war are really hitting, you know, both ends of the mining complex, your precious metal miners and your industrial metal producers.
Okay, let's talk about gold for a moment. We've seen it move down despite the uncertainty. We're used to seeing it as a safe haven. I'm wondering if you think this trend will continue.
Well, I certainly think, you know, if you look at the trend of gold leading into this, it was just on such a tear. You know, that actually gold actually started correcting before the war even broke down. But it's clear that gold price probably got a little bit ahead of itself, the so-called debasement trade due to the trade war that the U.S. Was involved with the rest of the world. People really looking for sort of havens and hedges against dollar weakness and weakness in U.S. assets. So we already saw that crack happen before the war started. It's really hard to say what would you know, cause this downturn to stop, given how elevated, how much momentum gold had earlier in the year. So you know, regardless of what the near-term trend is, it's going to be hard to see gold really skyrocketing back up to those nosebleed heights we saw earlier in the year.
Okay, how much of the drag down we're seeing for the TSX is coming from the metals, do you think?
Today was a very much so the metals. You saw companies like Barrick and Kinross Gold, Agnico, really among the biggest weights on the TSX. And really, again, some of the high-flying stocks in any index they're in. If you look at that MSCI Global Metals and Mining Index, incorporating miners around the world, it was up something like 30% just year to date prior to the war. Last year was up 60%. So really, among some of the most high-flying stocks in whatever market they're in. Not only are they down today, but really kind of threatening to bring that TSX negative year to date due to how pronounced these moves are. I think the TSX did manage to close a little bit in the green year to date, but really flirting with going negative year to date along with the U.S. and European indexes.
All right, we will leave it there. We have Bloomberg's Michael Regan joining us. Thanks for the update. Appreciate it. Jack Hughes scored the golden goal for the U.S., but the puck ended up in Toronto's Hockey Hall of Fame. And now he wants it back, and it's sparking a cross-border dispute. We are joined by Bloomberg's Ari Alstetter on this.
It came out in some interviews Jack Hughes did in the last few weeks that he didn't know where the golden goal puck was and that he actually would like it back. Eventually, it came out that the golden goal puck was currently on display at the Hockey Hall of Fame in Toronto. So when ESPN asked Jack Hughes about that a few nights ago, he expressed anger at that he should be the one to have the puck, that he was actually trying to get it back, and he didn't know why it had gotten to the Hockey Hall of Fame in the first place. Those comments kicked up a bit of a brouhaha online. They got a lot of attention. They sparked a lot of discussion in forums like Reddit about whether he had a right to want the golden goal puck, which is the kind of thing that the NHL often allows players to have, those kind of memorabilia from games. Or whether it was better off being displayed at the Hockey Hall of Fame for the public to see and enjoy, which has sort of been the tradition for memorabilia used in Olympic hockey and international tournament hockey. This kind of debate raged until, last night actually, Hughes was asked about it after the game as well, and he seemed to concede that he probably wasn't getting the puck back and that perhaps the Hockey Hall of Fame might be an okay place for it.
An okay place. It's awesome to go there. I guess it's a question of who legally owns it, right? I mean, does the International Ice Hockey Federation own the puck? And if somebody does score a goal, they can say, okay, you can keep the puck? Or is it up for grabs? Is it fair game?
No, the International Ice Hockey Federation is, the owner, the custodian, if you'd like, of this kind of shared kit that's used in international hockey tournaments. They help administer these tournaments, including the Olympics. And so traditionally, since I believe 1998, which was probably the Nagano Games, the International Ice Hockey Federation has turned over significant memorabilia like big golden goal pucks to the Hockey Hall of Fame. This has been a long-standing tradition of donation between those two sort of institutions. But of course, as I said earlier, that kind of runs counter to what the NHL usually does, and what Jack Hughes is probably used to in NHL games and other games in his career, where if you score an important goal, maybe you get the puck. That's not the same tradition in international tournament hockey, and that seems to be where the kind of tension came up about this issue.
Bloomberg's Ari Alstetter there. Let's have a quick look at how we ended the day. The TSX took a big hit today, down 1.4%, or a 457-point drop on the day. The S&P, not a material move. It's down 18 points today And then the Nasdaq had a 61-point drop, so about a third of 1%. Metals taking the biggest hit and dragging the TSX down, both gold and silver, as well as industrial metals, which are heavily weighted in the TSX. That does it for the close today. Thanks for joining us. We'll see you tomorrow.
Tonight, an exclusive W5 investigation. 4 Canadians behind bars in Hong Kong claim they were set up. We tracked down their alleged recruiters.
I'm just a young kid trying to make a little bit of money.
Accused of tricking them into delivering cocaine-filled suitcases.
What did you think was in the suitcase?
W5 follows the trail from Hong Kong jail cells back to the Canadians accused of sending them there. Tonight on CTV National News and ctvnews.ca.